Hello everyone, I'm delighted to have you with me today on our last topic. Today we take up a chapter that is both conceptually interesting and extremely important in practice. TDS and TCS under GST. So keep your income tax knowledge aside for now and approach this chapter with fresh eyes. Let us begin. As we always do, let us first understand what exactly we will be covering in this chapter. The slide shows us 5 broad topic areas. First, we look at the need for TDS and TCS. Why were these provisions introduced in GST? What problem were they trying to solve? Understanding the why always makes the what and how much easier to remember. Second, we study who is liable to deduct tax at source. The TDS deductors, which categories of organizations and entities must deduct TDS under Section 51, and importantly, who is exempt from this obligation. Third, we cover the compliance for TDS, the practical side of TDS implementation, including registration, rates, deposit deadlines, return filing, and the consequences of non-compliance. Fourth, we move to the TCS side and understand who is liable to collect tax at source, primarily e-commerce operators, and the scope of the TCS obligation under Section 52. And fifth, we examine TCS compliances, how e-commerce operators must register, deposit, file returns, rectify errors, and handle discrepancies. These 5 areas together give you a complete picture of both TDS and TCS under GST. Let us begin from the very beginning, the introduction. Every tax system, no matter how well designed, faces the challenge of ensuring that taxes are actually paid on every transaction. In India, particularly among smaller businesses and large decentralized sectors, 2 problems were very common. First, many businesses would underreport their transactions, show lower invoice values to reduce their GST liability. Second, the rise of e-commerce created a new complexity. Thousands of sellers operate on a single platform like Amazon or Flipkart, and ensuring each of them is properly reporting and paying tax became a monitoring challenge. To address these twin problems, the CGST Act 2017 introduced 2 mechanisms: tax deduction at source under Section 51 and tax collection at source under Section 52. Let us understand each of them at a conceptual level. TDS, tax deduction at source, operates on a simple principle. When a specified government or government-related entity makes a payment to a supplier for taxable goods or services, it deducts a small percentage of the payment as tax before remitting the rest to the supplier. The deducted amount goes directly to the government. This ensures that tax is deducted at the time of payment itself, creating an audit trail and making it difficult to underreport the transaction. TCS, tax collected at source, works on a parallel principle in the e-commerce space. When an e-commerce operator like Amazon or Flipkart facilitates a sale and collects the payment on behalf of a third-party seller, it retains a small percentage as TCS before paying the seller. This TCS goes to the government. Since the platform controls the cash flow of thousands of sellers, this is a highly effective mechanism to ensure tax compliance across the entire e-commerce ecosystem. Together, TDS and TCS help streamline tax collection, improve transparency, and strengthen compliance across industries. They represent the GST system's proactive approach to ensuring taxes are paid at source rather than relying entirely on voluntary compliance. Now let us understand who exactly is required to deduct TDS under GST. Section 51(1) of the CGST Act lists four categories of TDS deductors. Category A: central or state government departments or establishments. Any department or establishment of the central government or a state government that makes payments to suppliers is a TDS deductor. So if the Ministry of Railways makes a payment for supplies of materials, or a state PWD department pays a construction contractor, TDS must be deducted. Category B: local authorities. Municipal corporations, panchayats, cantonment boards, and other local bodies are TDS deductors. When they make payments to their suppliers, they must deduct TDS. Category C: governmental agencies. Any agency of the government that makes taxable purchases must deduct TDS. Category D: any other persons or categories notified by the government. Beyond the above, the government can notify additional categories of persons through a gazette notification. And this is exactly what happened through notification number 50/2018-Central Tax, dated 13 September 2018, which was subsequently amended from time to time. This notification expanded the list of TDS deductors to include three additional categories. First, public sector undertakings, or PSYs. These are government-owned companies, and since they handle enormous volumes of procurement, their inclusion significantly expanded the TDS net. Second, authorities, boards, or bodies that satisfy either of two conditions. They are set up by an Act of Parliament or state legislature, or they are established by any government. With 51% or more government ownership, whether through equity or control, and they perform any function. This covers bodies like SEBI, IRDAI, various development boards, and infrastructure authorities. Third, societies formed by the central government, state government, or local authorities under the Societies Registration Act 1860. Many government-backed societies and welfare organizations fall into this category. So the TDS deductor list is quite broad. It covers not just the core government, but extends to PSS, statutory bodies, and government societies. If you are making a supply to any of these entities, be prepared for TDS to be deducted from your payment. Having understood who must deduct TDS, let us now look at the flip side. Situations where TDS is not required to be deducted even by an otherwise eligible deductor. There are three important exemptions. The first exemption is the Ministry of Defense exemption. Authorities under the Ministry of Defense are generally exempt from the TDS provisions, with one exception: those entities specifically listed in Annexure A to the relevant notification and their offices are not exempt and must deduct TDS. So the defense establishment as a whole gets a broad exemption, but the government has carved out specific defense entities that are still within the TDS framework. The second exemption covers PSU to PSU transactions. If one public sector undertaking is making a payment to another PSU, no TDS is required, even if both are distinct entities. Think of it this way: ONGC buying materials from BHEL Both are PSUs under the government umbrella. Deducting TDS in such inter-PSU transactions would simply mean government money circulating within the government system, which is operationally inefficient. Hence, this exemption exists. The third exemption covers transactions between notified entities. No TDS is required on the supply of goods or services between entities that are themselves covered under Section 51, 1A, B, C, or D, meaning government departments, local authorities, governmental agencies, and other notified entities. So, if one government department is purchasing from another government department, or a local authority is buying from a PSU, no TDS is deducted. Again, the rationale is that these are all government entities, the tax compliance is already inherent in the system, and circular deduction and deposit would be unnecessary. These three exemptions are clean, logical carve-outs. Keep them in mind, as exam questions often test whether students know not just who must deduct TDS, but also when TDS is not required. Now, let us understand when exactly TDS must be deducted. The trigger is quite specific, and understanding it precisely is important. TDS must be deducted from the payment made or credited to the supplier, who is called the deductee, when the payment is for taxable goods and / or services under a contract, and the total value of supply under that contract exceeds rupees 2,50,000. Please note that very carefully. The threshold is the total contract value, not the individual invoice value. This distinction is crucial. Even if an individual invoice is below 2,50,000 rupees, TDS must still be deducted if the total contract value exceeds 2,50,000 rupees. For example, if a government department signs a contract worth 10 lakh rupees with a supplier, and the supplier raises 10 invoices of 1 lakh rupees each, TDS must be deducted on each payment. Because the total contract value exceeds 2,50,000 rupees, even though each invoice is only 1 lakh rupees. Another very important point, only taxable supplies are considered for TDS deduction. If a supply is exempt from GST, it does not attract TDS. TDS applies only where GST is applicable on the supply. Now, what is the value of supply for TDS calculation? This is also clearly defined. The value of supply for TDS purposes is the amount indicated in the invoice, but excluding all GST components. Specifically, the GST components excluded are central tax, CGST, state tax, SGST, union territory tax, UTGST, integrated tax, IGST, and cess. So TDS is calculated on the base value of the supply, not on the invoice value inclusive of tax. This is logical. TDS is a withholding on the commercial value, and the GST itself is a tax that the government collects anyway through other mechanisms. Now let us look at the TDS rates. The rate structure under GST TDS is simple and follows the same logic as GST itself. Intrastate supplies attract CGST plus SGST/U TGST, while interstate supplies attract IGST. For intrastate supplies, that is, where the supplier, place of supply, and recipient are all in the same state or union territory, TDS is deducted at 1% CGST and 1% SGST or UTGST. So the total TDS rate for intrastate supplies is 2% in total, split equally between the center and the state. For interstate supplies, where the supply crosses state or UT boundaries, TDS is deducted at 2% IGST. The IGST rate matches the combined rate of CGST and SGST slash UTGST for intrastate supplies, maintaining consistency. So, the practical answer to what is the TDS rate under GST is 2%, whether intrastate, split as 1% CGST plus 1% SGST slash UTGST, or interstate as 2% IGST. This is a simple and easy number to remember. Students, please remember that this 2% is on the taxable value of the supply, excluding GST. Let me also note that the maximum TDS rate permissible under the Act is 2%. It cannot exceed this. The government may notify lower rates for certain categories, but the ceiling is 2%. The applicability of TDS depends on the location of the supplier, the place of supply, and the registration of the recipient deductor. The slide shows us a table that captures 3 scenarios. Let me walk you through each carefully, because this is an area where students frequently get confused. Scenario 1. Location of supplier is state or UTA, place of supply is state or UTA, and the recipient or deductor is also registered in state or UTA. This is a simple intrastate transaction. Everything is in the same state. In this case, TDS is applicable under Section 51. The applicable TDS rate is CGST 1% and SGST slash UTGST 1%, the standard intrastate TDS rates. Scenario 2. Location of supplier is state or UTA, place of supply is state or UTB, and the recipient is registered in state or UTB. This is an interstate transaction. The supplier is in state A, but the supply is consumed in state B and the buyer is in state B. In this case, TDS is applicable. The applicable rate is IGST 2%. Scenario 3. Location of supplier is state or UTA, place of supply is state or UTA, but the recipient or deductor is registered in state or UTB. This is an interesting and slightly tricky scenario. The supply is happening within state A. The supplier and place of supply are both in state A, but the deductor, the government entity making the payment, is registered in state B. In this case, TDS is not applicable. The reason is that TDS would normally result in CGST and SGST of state A being deducted, but the deductor is registered in state B and cannot account for state A's SGST. The GST law avoids this mismatch by simply not applying TDS here. This third scenario is important for examinations. The key principle: TDS does not apply when the supplier's state of supply and the deductor's state of registration are different. The deductor must be in the same state as the place of supply for TDS to apply on intrastate transactions. Now let us understand the compliance obligations for TDS deductors. The practical steps they must follow after deducting TDS. Step 1. Registration. Any person who is required to deduct TDS under Section 51 must compulsorily obtain GST registration under Section 24 of the CGST or SGST Act. This registration is mandatory regardless of their turnover The standard turnover threshold does not apply to TDS deductors. They need registration specifically to fulfill their TDS obligations. And importantly, this registration is for the deductor as a TDS entity. It is separate from any existing GST registration the entity may have as a taxable person. Step 2. TDS deposit under section 51(2). Once TDS is deducted, the deductor must deposit the deducted amount with the government within 10 days after the end of the month in which TDS was deducted. So if TDS was deducted in August, it must be deposited by the 10th of September. The 10-day timeline is tight and must be adhered to strictly. Step 3. TDS return filing under section 39(3) and rule 66(1). The deductor must file a monthly TDS return in form GSTR 7 for the month in which TDS was deducted within 10 days of the next month. So if TDS was deducted in August, GSTR 7 must be filed by the 10th of September, the same deadline as the deposit. GSTR 7 contains the details of all supplies on which TDS was deducted and the amounts deducted and deposited. Step 4. Claiming TDS in the electronic cash ledger under section 51(5) and rule 66(2). This is the benefit side for the supplier who had TDS deducted from their payment. After the deductor files GSTR 7 and the GST system validates it, the deducted TDS amount is automatically credited to the supplier's, the deductee's electronic cash ledger. The supplier can then use this credit to pay their own GST liabilities. This is analogous to how TDS credit works in income tax. The amount deducted on your behalf becomes a credit that you can use against your tax dues. Now let us look at what happens when things go wrong. When TDS is deducted incorrectly, in excess, or not deposited on time. The law addresses three key scenarios. The first scenario is a refund of excess or erroneous deduction under section 51(8). What if a deductor deducts more TDS than was applicable or deducts TDS when it should not have been deducted? In such cases, the excess or erroneously deducted amount is refundable under section 54. However, there is a very important condition here. No refund is given to the deductor if the deducted amount has already been credited to the deductee's electronic cash ledger. Why? Because once the credit has reached the supplier's ledger, the supplier has already benefited from it. They can use it for their tax payments. If the deductor were also to get a refund, the government would effectively be paying the same amount twice. So the rule is refund is available only if the TDS has not yet been credited to the deductee's ledger. If it has been credited, the deductee themselves must claim a refund or adjust the credit. The second consequence is interest on late payment under section 51(6). If the deductor fails to deposit the TDS with the government by the due date, which is 10 days after the end of the month of deduction, they must pay interest at 18% per annum as per section 51. This is the standard late payment interest rate under GST, and it applies from the day after the due date until the actual date of deposit. The third consequence is the determination of default under section 51(7). Any default in TDS payment, whether it is non-deduction, short deduction, or non-deposit after deduction will be assessed under Section 73 or Section 74 of the CGST Act. Section 73 applies to cases of non-fraud, where the default happened without deliberate intent to evade. Section 74 applies to cases involving fraud, suppression, or willful misstatement. Depending on the nature of the default, the appropriate determination and penalty provisions kick in. We have now completed our study of TDS. Let us now shift to the second major topic, tax collection at source or TCS, governed by Section 52 of the CGST Act 2017. What is TCS under GST? TCS refers to tax collected by e-commerce operators or ECOs when they facilitate sales of goods or services through their platform. Think of platforms like Amazon, Flipkart, Meesho, Swiggy, Zomato, Ola, Uber, Make My Trip, and so on. These platforms act as intermediaries between sellers and buyers. When a buyer pays for a product or service through the platform collects the payment. And before remitting the seller's share, the platform retains a small percentage as TCS and deposits it with the government. Who is liable to collect TCS? Every electronic commerce operator or ECO that is not acting as an agent must collect TCS on the net value of taxable supplies made through its platform by other suppliers, where the consideration for those supplies is collected by the ECO. Let me break this down. The ECO must 1. Be facilitating a supply, not making the supply itself. 2. Not be acting as an agent. If it is the agent of the supplier, TCS does not apply. 3. Be collecting the payment from the buyer. If the payment is made directly from buyer to seller without passing through the ECO, no TCS. What is the net value of taxable supplies for TCS? The net value for a month is calculated as total taxable supplies made through the ECO during the month minus supplies returned during the month. So, returns and cancellations reduce the base on which TCS is calculated. This is a fair provision. The ECO should not collect TCS on transactions that were ultimately reversed. What are the rates of TCS? For interstate supply, when the seller and buyer are in different states, TCS is collected at 1% IGST. For intrastate supply, when the seller and buyer are in the same state, TCS is collected at 0.5%, CGST plus 0.5%, SGST or UTGST. So the total TCS rate is 1% in both cases, either as 1% IGST or as 0.5%, CGST plus 0.5%, SGST slash UTGST. Note that TCS rate is exactly half the TDS rate. TDS is 2%, while TCS is 1%. TCS under GST does not apply universally to every transaction on an e-commerce platform. There are two broad categories of exceptions. First, specified services under Section 9(5), where the ECO itself becomes the taxpayer, and second, several other specific situations. Let us start with Section 9(5), notified services. Under Section 9(5) of the CGST Act, the government can notify certain services where the ECO is directly liable to pay GST, not the actual service provider. In these cases, the ECO is the taxpayer, so collecting TCS in addition would mean double taxation. Hence, TCS does not apply to these Section 9(5) services. Notification number 17/2017 Dash Central Tax Rate dated 28 June 2017 covers 4 such categories. First, passenger transportation services. Services provided through radio taxis, app-based cabs, bikes or buses. Think Uber, Ola, Rapido, Redbus. The EKO is directly liable to pay GST on the cab fare. The driver does not separately collect and pay GST. TCS is not applicable here since the ECO is already the taxpayer. Second, hotel accommodation services booked via ECO like OIO, Make My Trip, Goibibo, unless the hotel itself is compulsorily required to register under GST. If the hotel is a large registered taxpayer paying GST on its own, the Section 95 provision does not apply. But for small, unregistered accommodation providers listed on OEO, the ECO pays GST directly. So no TCS. Third, housekeeping services booked through ECO, like plumbing, carpentry, painting, electrical work, booked through urban company, unless the service provider must register under GST themselves. Fourth, restaurant services where food is delivered through ECOs like Swiggy or Zomato, except for restaurants located in specific places like airports or large business complexes. For these special location restaurants, the normal GST rules apply and TCS may be collected. Now, let us look at the other cases where TCS is not applicable. 1. Exempt supplies. If the supply is GST exempt, there is no tax to collect at source. 2. ECO acting as agent. TCS applies only when the ECO facilitates the supply. If the ECO is acting as an agent for the principal, it is the principal who is making the supply, not a third party. TCS does not apply. 3. No direct consideration. If the ECO does not collect the payment from the buyer, say the buyer pays the seller directly, TCS is not required since the ECO never has control over the payment. 4. Own account sales. If a supplier sells products through their own website or app and not through a third-party ECO, TCS is obviously not applicable since there is no ECO involved. 5. Reverse charge supplies. When the recipient pays GST under the reverse charge mechanism, TCS is not collected since the compliance burden is already on the recipient. 6. Imports. Import of goods falls under the Customs Act 1962 and is not within the purview of GST TCS. Now let us look at the compliance obligations for e-commerce operators who are required to collect TCS. The compliance framework mirrors TDS in many ways but has its own specific provisions. Step 1. Registration under Rule 12. Every ECO that is liable to collect TCS must apply for GST registration online. The GST officer will verify and approve the registration within 3 working days. This is a faster timeline than normal GST registration, recognizing that ECOs are typically large, well-established platforms. If the ECO is no longer liable to collect TCS, say if it stops facilitating third-party supplies, the registration can be cancelled by the officer under Rule 22. Step 2. TCS deposit under Section 52(3). The TCS collected must be deposited with the government within 10 days of the next month. So TCS collected during August must be deposited by the 10th of September. This is the same deadline as TDS deposit, the 10th of the following month. Step 3. Filing of monthly and annual statements. ECOs must file two types of returns. First, GSTR 8, the monthly statement, which must be filed within 10 days after the end of each month. GSTR 8 contains details of all supplies made through the ECO, any returns or cancellations, and the TCS collected. So, for August, GSTR 8 is due by 10th September. Second, GSTR 9B, the annual statement, which must be filed by December 31st after the end of the financial year. The Commissioner has the power to extend these due dates for any category of registered persons if needed. Step 4. Claim of TCS in electronic cash ledger under section 52(7) and rule 67(2). After the ECO files GSTR 8, the TCS collected by the ECO is automatically credited to the supplier's electronic cash ledger. The supplier can then claim and use this amount for making their own tax payments. So, from the seller's perspective, who is selling on Amazon, for example, the TCS that Amazon deducts from their payments shows up as a credit in their GST cash ledger, which they can use to discharge their output tax liability. What happens if an ECO discovers an error in the GSTR 8? It has already filed. The law provides a mechanism for rectification along with a time limit and a late fee structure. Rectification of errors in GSTR 8 under section 52(6). If an ECO discovers an error or omission in its GSTR 8, for example, it accidentally omitted some supplies or reported a wrong TCS amount, it can rectify it by including the correction in the next GSTR 8. So, the error in August's GSTR 8 is corrected in September's GSTR 8. However, there is a very important caveat. Errors or omissions that are discovered during scrutiny, audit, or enforcement activities, meaning the department found the error first, cannot be self-rectified. Only errors discovered by the ECO itself on its own without external enforcement qualify for rectification through the next return. Time limit for rectification under the proviso to section 52(6). The rectification must happen by the earlier of two dates, November 30th of the next financial year or the actual date of filing of the annual statement in GSTR 9B. In practical terms, since GSTR 9B is due by December 31st and corrections must be made before that, in the monthly return, the effective deadline is the October GSTR 8 of the following financial year. So, for a mistake in August 2024's GSTR 8, the last opportunity to rectify it is in the October 2025 GSTR 8, that is approximately 14 months. Late fees for delay in filing GSTR 8 under section 47(1). If an ECO files its GSTR 8 after the due date, late fees are levied. The late fee is 200 rupees per day of delay, that is 100 rupees per day for CGST and 100 rupees per day for SGST. However, there is a maximum cap on the late fee. The total late fee cannot exceed 10,000 rupees, 5,000 rupees for CGST and 5,000 rupees for SGST. So even if an ECO files GSTR 8 very late, the maximum late fee they will pay is 10,000 rupees. Beyond that, the late fee clock stops. One of the most important aspects of the TCS compliance system is how GSTR 8 data filed by the ECO is matched against GSTR 1 data filed by the supplier. This matching process ensures that both sides of every e-commerce transaction are consistently reported. Let me walk you through the four-stage process shown in this slide. Stage 1. Matching of GSTR 8 with GSTR 1 under Section 52(8) and Rule 78. The details of supplies that the ECO reports in its GSTR 8 are automatically matched by the GST system against the supplies that the individual supplier has reported in their GSTR 1. The matching is done based on two parameters: the state of place of supply and the net taxable value. If the GSTR 1 due date is extended by the government for any reason, the matching window is also extended accordingly, keeping the process synchronized. Stage 2. Communication of discrepancies under Section 52(9). If the system finds a mismatch, say the ECO's GSTR 8 shows sales of 5 lakh rupees from a seller, but the seller's GSTR 1 shows only 4 lakh rupees. The discrepancy of 1 lakh rupees is communicated electronically to both the ECO and the supplier. Both parties are notified so they can examine and resolve the mismatch. Stage 3. Increase in output liability if not rectified under Section 52(10). If the supplier does not correct the discrepancy, meaning the mismatch remains unresolved, the excess value reported in the ECO's GSTR 8 over what the supplier reported in GSTR 1 is added to the supplier's output tax liability in the next return period. So, the system takes a conservative approach. It trusts the ECO's data. Since the ECO is a large platform with better record keeping, and adds the unexplained difference to the supplier's tax liability. Stage 4. Supplier to pay additional tax plus interest under Section 52(11). The supplier must pay the additional tax that has been added to the output liability along with interest at 18% per annum as per Section 51, running from the due date until the date of actual payment. So if a seller on an e-commerce platform underreported their sales in GSTR 1 and the ECO's GSTR 8 exposes the discrepancy, the seller will face both the tax demand and the interest burden. This four-stage matching process is a very powerful anti-evasion tool. The ECO's GSTR 8 effectively serves as a cross-check on the supplier's GSTR 1. Sellers cannot hide their e-commerce sales because the platform is already reporting them to the government. Our final slide in this chapter deals with a special power that tax authorities have over e-commerce operators: the power to compel them to disclose information about supplies and stock held on their behalf. Under Section 52(12), a deputy commissioner or any officer of higher rank, that is, joint commissioner, additional commissioner, or commissioner, may issue a notice to an e-commerce operator requiring them to provide two types of information. First, details of supplies of goods or services made through the ECO, the full transaction history. Second, details of stock held in godowns or warehouses managed by the ECO. This second point is particularly significant in the context of platforms like Amazon or Flipkart that operate large fulfillment centers. Warehouses, where third-party sellers store their goods. The government wants visibility not just into transactions, but also into the physical stock that sellers have parked in these eco-managed warehouses. The slide also notes that these godowns or warehouses managed by ECOs can be declared as additional places of business by the sellers who store goods there. How is this notice served? The notice is served electronically in Form GST DRC-01 as per Rule 142(1)A. The use of a digital form ensures speed and creates an electronic record of the notice. What is the ECO's reply deadline? Under Section 52(13), the ECO must respond to the notice within 15 working days from the date of receipt of the notice. The response must include the details of supplies and stock as required. What is the penalty for non-compliance? Under Section 52(14), if the ECO fails to respond within the stipulated time, it can face a penalty of up to 25,000 rupees. This is in addition to any other legal actions that may be initiated under Section 122, which deals with general penalties for GST offences. The 25,000 rupees cap is relatively modest given the scale at which major ECOs operate, but it is supplemented by the broader penalty provisions of Section 122, which can be significantly more severe. This provision underscores a key principle of GST administration. E-commerce operators are not merely passive conduits. They are active participants in the tax compliance ecosystem with significant obligations to maintain transparency and cooperate with tax authorities. And with that, students, we have completed chapter 14, TDS and TCS. And with this chapter, we have also reached the end of our complete indirect tax course. From the very concept of supply, all the way through valuation, registration, input tax credit, invoicing, returns, payment of tax, e-way bills, accounts and records, and finally, TDS and TCS. You have covered every corner of this subject with dedication and sincerity. That is something to be genuinely proud of. GST is not just an examination subject. It is the language of commerce in modern India. Every invoice, every credit claim, every return, every payment, everything you have studied here plays out in the real world every single day. The knowledge you have built in this course will serve you throughout your professional career. As you head into your revision, focus on the logic behind the provisions, not just the numbers. Understand why each rule exists, and the details will come naturally. Create your summary tables, revise the key thresholds and deadlines, and practice application-based questions. On behalf of the entire contemporary learning team, thank you for being part of this journey. It has been a privilege to teach you. All the very best.